Gold is doing something that makes traders comfortable while making physical buyers quietly nervous. The screen price looks clean, the chart looks orderly. And yet, in the real world, the metal is starting to cost more than the official price to actually obtain, right now in hand. That difference is called the premium. And when premiums start rising fast across multiple physical channels, bars, coins, kilo products, regional wholesale hubs, it usually isn't because someone woke up and felt emotional. It's because the market is revealing friction. Logistics friction, inventory friction, trust friction, the kind of friction that paper markets can ignore until they can't. Let that sink in. A market can quote a price all day long, but if the product at that price becomes harder to source, the premium becomes the real headline. Start with the basic contradiction. Gold can be down on the day, while physical gold is up in the only way that matters to a real buyer, the all-in price. That's when dealers start widening spreads, mints stretch delivery times, wholesalers ration product. Here's what needs to be understood. Gold has two markets living on top of each other. One is the paper market, futures and forwards, mostly settled financially, where leverage and hedging dominate. The other is the physical market, bars that must be refined, assayed, shipped, insured, and stored. The paper market is fast and deep. The physical market is real and constrained. When both move together, nobody notices. When they diverge, that's the signal. And right now, the divergence is showing up in a very specific way. Physical premiums are rising even when the paper price is volatile, sometimes even pulling back. That combination is not normal, and it's not random. A clean way to visualize this is to imagine two thermometers. The paper price is the temperature on the wall, updated every second, convenient, broadcast everywhere. The physical premium is the temperature of the water in the pipes, harder to measure, slower to change. But when it spikes, something is happening behind the walls. So why are gold premiums rising fast in physical markets? Because demand is not just increasing, it's shifting toward immediacy and certainty. And because supply is not just tight, it's unevenly available, unevenly distributed, and sometimes trapped behind policy, tax, refinery capacity, and shipping reality. This is not just about people wanting gold, it's about what kind of gold they want and how fast they want it. A few hard data points frame the moment. According to the World Gold Council's reporting highlighted in major financial coverage, global gold demand in 2025 pushed above 5,000 metric tons for the first time, with total demand value described around the mid-hundreds of billions of dollars, and investment demand surged sharply year over year. That matters because investment demand behaves differently than jewelry demand. Jewelry is often price-sensitive. Investment demand is often fear-sensitive, and fear can turn into a scramble quickly. Central banks are also part of the story. The World Gold Council's full year 2024 data shows central banks added 1,045 tons to reserves, marking the third straight year above 1,000 tons. That is not a retail buyer paying a premium for a 1-ounce coin. That's institutional strategic accumulation of physical metal on a scale that quietly tightens the underlying system. 5% of total reserves. That's important for one reason. It reinforces a cultural and institutional signal. Gold is being treated as a strategic asset, not a trade. In India, the World Gold Council's December 17, 2025 update described international gold around $4,147 per ounce by December 12th, with domestic pricing showing a deeper discount versus international, nearly $30 per ounce, while investment demand for bars and coins remained strong even as jewelry volumes softened. That nuance matters. Retail premiums include fabrication, supply chain, inventory risk, and product-specific demand. And in London, still a core hub for global bullion, the LBMA's vault data reported that at the end of December 2025, gold held in London vaults totaled 9,106 tons, valued in the trillions of dollars, representing hundreds of thousands of bars. Much of it is allocated, tied to ETFs, central bank holdings, custodial structures, and leasing arrangements. Big piles do not automatically equal easy supply. Now zoom in, because the real story of premiums is not just total demand. It's where demand is pressing against bottlenecks. Physical gold isn't one product, it's many products. A 400-ounce London good delivery bar is not the same as a 1-ounce minted coin. A kilo bar is not the same as a 10-gram bar. And during stress, the wrong product in the wrong location can become effectively scarce, even if gold broadly is plentiful. This is why the plumbing matters. The spot price most people quote is heavily influenced by paper trading, tied to LBMA benchmarks and COMEX futures. COMEX futures are standardized contracts, typically 100 troy ounces, traded in huge volume, and most contracts never end in delivery. The system relies on the assumption that delivery is possible, but it does not require delivery for most participants to function day to day. Physical markets, by contrast, care about one thing. Can metal be delivered in the form needed, to the place needed, when needed? When demand spikes for immediate delivery, premiums rise for the products most in demand. That often means small bars and popular coins, and that often means fractional sizes, where fabrication costs are higher per ounce and retail demand is strongest. Even in normal times, fractional products often carry larger percentage premiums than full-size bars because the minting and distribution costs don't shrink linearly with size. Guidance from major bullion dealers and educational materials commonly notes that fractional gold coins can carry double-digit percentage premiums, sometimes in the low to high teens, especially when demand is hot and supply is constrained. Now, add a rapidly rising underlying gold price. When gold is expensive, the dollar value of fabrication, hedging, and inventory risk rises too. A dealer holding inventory is taking price risk. A wholesaler promising delivery is taking logistics risk. A mint running capacity is taking production risk. All of that gets embedded into premiums. Here's where it gets really interesting. Premiums can rise even if the overall gold price is not exploding that day, because premiums are not purely a price story. They're a confidence story about availability. That's why the best way to understand rising premiums is to treat them like stress fractures. They don't appear because everything is fine. They appear when pressure is building under the surface. There's a historical parallel that shows exactly how this mechanism works. In late March 2020, as lockdowns grounded flights and disrupted refining, the gold market experienced a rare and messy dislocation between London spot and New York futures. Reuters, reporting at the time, described futures trading at a premium that reached as much as $70 per ounce over spot. A huge gap for a market that normally trades nearly in lockstep. That wasn't because gold became more valuable in New York than London in some philosophical sense. It was because the ability to move the right bars into the right warehouses in time broke down. CME even introduced an enhanced delivery futures contract, designed to allow delivery flexibility across 400-ounce, 100-ounce, and kilo bar sizes, explicitly to address those delivery constraints and mismatches. That episode matters today for one reason. It proved that gold can temporarily split into separate realities depending on form and location. When the pipes clog, the posted price becomes less authoritative than the delivered price. Today's premium surge is not identical to March 2020, but the mechanism rhymes. Physical constraints express themselves as premiums first. Now connect the dots with the macro backdrop, because physical premiums don't rise in a vacuum. Gold is not just a commodity, it's a monetary asset that competes with trust. Trust in currencies, trust in fiscal discipline, trust in geopolitical stability, trust in the idea that financial claims will always be honored smoothly. When those forms of trust weaken, even slightly, demand for tangible settlement strengthens. But the behavior is the same, a preference for assets without counterparty risk. That preference has been growing for years. Central bank accumulation, more than 1,000 tons in 2024, is not a random headline. It is a structural shift, and structural shifts don't usually reverse overnight. At the retail level, the motivations vary. In some regions, currency weakness pushes households toward gold as savings. In other regions, political uncertainty pushes wealth toward portability. And when those motivations converge across regions, premiums rise quickly because the physical supply chain cannot instantly stretch. Because the physical supply chain is not a magic tap. Refining capacity is finite. Minting capacity is finite. Secure logistics are finite. Vault throughput is finite. The number of authorized distributors for government-minted coins is finite. Even the availability of blank planchets, the metal discs used to strike coins, can become a bottleneck. So the first driver of rising premiums is simple. Real-world constraints meeting real-world urgency. But there's a second driver that's even more important. Market segmentation. When buyers move from gold exposure to gold possession, the paper market and the physical market stop being interchangeable. ETFs may satisfy exposure, but not possession. Futures may satisfy speculation or hedging, but not ownership in hand. Even allocated accounts require trust in custody and withdrawal processes. A rising premium is the market charging extra for possession, and charging extra for speed. That's why premiums often rise fastest during periods of high volatility, because volatility punishes inventory holders. When gold swings hard, dealers protect themselves by widening spreads and raising premiums. It's not greed, it's survival math. Now layer in technical market behavior. Because price action shapes psychology, and psychology shapes demand. Gold has been moving through a regime where big moves are becoming more common. In late January 2026, major market coverage described gold surging to record highs above $5,500 per ounce, before experiencing sharp pullbacks of several percent in a single session. That kind of volatility does two things at once. It attracts momentum-driven attention, and it triggers fear of missing out. But it also triggers fear of being trapped in paper claims during a spike. In technical terms, when an asset is trending strongly, pullbacks that hold above major long-term moving averages often invite buying on dips. Meanwhile, sharp intraday swings can increase implied volatility, which filters through to dealer hedging costs and inventory risk pricing. That cost, again, shows up in premiums. So the very thing that makes gold exciting on a chart, volatility, can make gold more expensive in the physical market because volatility is expensive to warehouse. Now, stop for a second, because a key misconception needs to be removed. Rising premiums do not automatically mean the paper market is fake or that a default is imminent. That's lazy thinking. The gold market is large, complex, and capable of adapting. But rising premiums do suggest the market is being asked to do something hard, satisfy immediate physical demand at scale, in specific forms, under changing geopolitical and macro conditions. This is a stress test of the system, and stress tests reveal weak points. Here are the main weak points that cause premiums to rise fast. First, location mismatch. Gold can be plentiful globally, but scarce locally. If a region experiences a demand surge while imports are constrained by policy, taxes, or currency controls, premiums rise locally even if global supply is fine. Second, form mismatch. Investors may want kilo bars while available inventory is in 400-ounce bars, or they may want 1-ounce coins while refineries are producing large bars. Converting one form into another requires time and capacity. Third, time mismatch. Paper markets price for future delivery. Physical buyers often demand immediate delivery. When now becomes more valuable than later, premiums rise. Fourth, trust mismatch. If buyers become less satisfied with exposure and more focused on possession, demand shifts toward deliverable products, stressing the retail and wholesale physical chain. Now, to keep this honest, the bearish case must be taken seriously because premiums can fall fast too. There are several reasons premiums could cool. One is simple. Supply catches up. Refiners can run harder. Dealers can restock. Mint output can increase. If demand stabilizes while supply expands, premiums compress. Another is price fatigue. When gold rises sharply, some buyers step back. Jewelry demand can weaken. Even investment demand can pause if people feel the move has already happened. A third is policy and currency effects. In markets like India and China, taxes, VAT rules, import quotas, and currency moves can rapidly change the local premium or discount landscape. The World Gold Council has documented how domestic premiums and discounts can widen meaningfully over short periods. If policy shifts make importing less attractive or reduce wholesale demand, premiums can cool. A fourth is macro headwinds. If real interest rates rise sharply or the dollar strengthens aggressively, gold can face pressure. A fast gold correction can spook retail buyers temporarily, and dealers might lower premiums to stimulate sales. And a fifth is substitution. Some buyers who cannot justify high gold premiums may shift to other assets, or to silver, or they may choose pooled products or ETFs instead of physical. That reduces pressure on physical inventory. All of that is real. But here's the part that should make you pay attention. The bearish case mostly explains short-term premium fluctuations. It does not erase the structural reasons why physical demand has been resilient and why premiums can rise quickly during stress, because the underlying drivers remain. Rising investment demand, strategic central bank, accumulation, and a global environment where uncertainty is not a temporary headline. It's a baseline condition. The answer is yes. The answer is that demand for immediacy and certainty is colliding with real-world constraints. And that collision is happening while gold is in a historically intense price and volatility regime. Now bring this down to practical implications, because the meaning of rising premiums changes depending on who's watching. For someone trading paper gold, futures, CFDs, or leveraged instruments, rising physical premiums are a warning light, not a trading signal. They're telling you the physical market is tight, but that tightness may not translate instantly into futures price movement. Paper markets can stay liquid while physical markets get strained. That can create opportunities. And it can create traps. A futures chart can look calm right until it doesn't. For long-term investors, especially those thinking in years, not days, rising premiums are a reminder to separate the idea of gold as an asset from the method of owning gold. Exposure is not the same as possession. Physical premiums rising are the market charging extra for the kind of ownership that removes counterparty reliance. For physical holders, the people who already own bars or coins, rising premiums can be interpreted as a real-world bid strengthening. It doesn't guarantee liquidity at peak premiums, but it suggests the market values immediate physical availability more than usual. That can matter during periods of broader market stress. For new buyers, especially those just entering, rising premiums are a prompt to be strategic, not to rush, not to panic, but to understand product selection. Premiums vary wildly by product type. Fractional coins can carry higher percentage premiums than larger bars. Government-minted coins can carry higher premiums than generic rounds. Certain bars are more liquid in certain regions. And all of that impacts break-even. Here's what you need to understand. The premium paid on day one is the hurdle that must be earned back before profit exists. Pay a 10% premium, and gold must rise 10% just to get back to even, before considering spreads on resale. So what can be done with this information? In a responsible, non-hype way. Start by monitoring indicators that can be independently verified. Look at regional premium and discount data from established market sources, especially in large consumer hubs like India and China, because those regions often reflect shifts in physical demand early. The World Gold Council's country market updates frequently discuss premium and discount dynamics and what's driving them. Track official sector buying and global demand trends. Central bank buying above 1,000 tons in 2024 was not a footnote. It was a structural signal. Monitor vault and inventory transparency where it exists. The LBMA publishes London Vault holdings, including December 2025 totals of 9,106 tons of gold in London vaults. Those numbers don't tell the whole story, but they do give context for flows and stock changes. And if delivery mechanics matter, use primary sources. CME publishes COMEX delivery notices and warehouse stock information directly. When stress appears, it often shows up in delivery behavior, spreads, and the market's attempts to adapt. Now, a crucial mindset shift. Rising premiums are not a prophecy, they are a diagnostic. They say, pay attention to where the physical market is tightening and pay attention to why. Because the why is the story. If premiums are rising because a mint is short on blanks, that's a short-term supply chain story. If premiums are rising because a region is restricting imports, that's a policy story. If premiums are rising across multiple products and regions while investment demand is surging, that's a trust and macro story. And when the story is trust and macro, it tends to last longer than a single quarter. Now, full risk disclosure, because this must be said clearly. Gold is volatile. Premiums are volatile. Premiums can spike during stress and collapse during calm. Liquidity can vary by product and region. Dealer buyback spreads can widen when volatility rises. Even highly liquid markets can experience temporary dislocations, like the March 2020 episode when futures diverged sharply from spot and forced contract innovation. No one can guarantee future prices. No one can guarantee premiums stay high. And no one should size any position in a way that creates financial distress if the market moves against them. This is analysis, not instruction. Information, not a promise. Education, not a guarantee. With that said, the core thesis remains. Physical gold premiums rise fast when the market is charging extra for certainty. When buyers don't just want exposure, they want delivery. When the pipes of refining, minting, and shipping can't instantly accommodate urgency. And when the broader environment pushes people to prefer tangible settlement over paper convenience. So, what are the 3 takeaways to walk away with? First, when premiums rise, the spot price is no longer the full price. The all-in physical price becomes the truth on the ground, and that truth can diverge from the screen. Second, premiums are signals of friction. Third, the most reliable approach is verification. Compare dealer pricing to spot. Track premium and discount commentary from institutions that publish market research. Watch official sector demand and global demand trend data. Use primary sources for delivery and warehouse information when analyzing physical tightness. Don't take anyone's word for it, including this script's framing. Verify independently. The data exists, and the market is always telling a story for those willing to look past the headline number. Because when physical gold starts trading with rising premiums, it's not just a pricing quirk, it's the market whispering that certainty has become more valuable. And when certainty gets expensive, something bigger is usually changing.